Welcome good people. Welcome to this session. We'll be discussing, this is question 4. Question 4. So let me just change the pen before we start. Just a minute. So, welcome good people. This is question 4. Question 4, as you can see, financial accounting, December 2021 sitting. Financial accounting, December 2021. It's a CPA paper, CPA and CFA. CPA, CFA foundation level financial accounting, December 2021 sitting. And this is question 4. The question is a combination of partnership accounts and manufacturing accounts. So we are going to basically learn concepts related to both manufacturing concerns and partnership accounts. It's a combination of the two, manufacturing and partnership accounts. So this is the question, and we'll go through it very fast. So question 4. Timothy and Lisa are in partnership, sharing profit and losses equally in a manufacturing venture. Timothy manages the manufacturing entity, while Lisa manages the selling and distribution of the end product. The following trial balance was extracted from their books for the year ended 30th September 2021. So we have the sales, purchase of raw materials, production wages, production supervisor salaries, office staff salaries, distribution cost, ignore the zeros, distribution cost, ignore the zeros, it's a continuation. So distribution costs, factory insurance, provision of unrealized profit, carriage inwards and out, carriage inwards of raw materials, cash at bank, 12% bank loan interest, accounts receivable, accounts payable, manufacturing royalties paid, bad debts written off, office administration expenses, fuel and electricity, inventory, and capital accounts, current accounts, drawings, factory buildings at cost, plant and machinery at cost, motor vehicle at cost, allowance for depreciation, have buildings, plant and machinery, and motor vehicle. Additional information. Inventories as of 30th September 2021 are valued as follows. Raw materials is 5,200. Sorry, there's something there. Raw materials is 5,200. Then you have work in progress. Work in progress is 2 million. This is 5.2 million, or 5,200 because we have restricted zeros. So work in progress is 2 million, and then finished goods is 3.6 million. Good. Then additional information number 2, depreciation is provided on cost as follows. Depreciation is provided on cost as follows. Is provided on, there's a mismatch, there's some effect here. Depreciation is provided on cost as follows. So we have buildings. Let me just get this right. So depreciation is provided on cost as follows. We have buildings 2.5%, 2.5% as per the question. Then you have plant and machinery 10%, this is 10%. And then you have motor vehicle at 20%. Those are the depreciations, and all of them are on cost. Depreciation is provided on cost as follows. So buildings 2.5%, plant and machinery 10%, and motor vehicle 20%. Manufactured goods are transferred to the warehouse at factory cost plus profit at 20% of the factory cost. That's okay. And number 4, the partnership agreement provided that each partner is entitled to a salary of 100,000 per month. Then 2, Timothy is entitled to 10% commission based on factory profit, while Lisa is entitled to a 10% commission based on the net profit. Good. Interest on capital is to be charged at 10% per annum, and interest on drawings is to be charged at 15% per annum. Then fuel and electricity are to be apportioned 80% factory and 20% office. Required manufacturing statement of profit and loss account for the year ended September 2021 and statement of financial position as at 30th September 2021. This is good. So that is the question. Financial accounting, December 2021, CPA question 4. So we will tackle the question very fast. And what is expected of us here is to come up with the manufacturing accounts. Then we come up with the financial statement. Manufacturing accounts will show the cost at which we are going to transfer the manufactured goods to the trading account. Then we come up with the financial statements, which will show us we'll start with the trading account, go to the profit and loss account, and end up with the appropriation account, because these are partnerships. So our financial statement will have trading account, profit and loss account, and the appropriation account together in one. So it will show the gross profit, of course, the net profit, and how the net profit will be utilized. And then after that, we'll prepare the statement of financial position as at 30th September 2021 to show the financial standing of the business in question. So let's start first things first. Timothy and Lisa partnership, and it's a manufacturing venture. So we'll simply say Timothy and Lisa. That's our heading. Remember, we said we must have a heading. So this is our solution, and we'll say Timothy and Lisa partnership. Timothy and Lisa partnership. Then you say manufacturing accounts, because that's what we are preparing. Manufacturing accounts. Then you say for the year ended 30th September 2021. So let's go to underline, and then you can come up with the columns that will help you. Preferably 3 columns are good. So like that. We've restricted the zeros, as the question has also restricted the zeros. So we'll go it that way. So let's start. And for manufacturing account, the steps are very simple. You start with the direct costs, then we go to the factory overheads, and then the rest. So we will come up with the prime costs, then we go to the factory cost, then we come to the total cost of production. Those are the 3 stages, and the prime cost is made up of the direct materials, then we have the direct labor, and if we have any direct expense. So for our manufacturing concern, we always start with the direct materials, and most of the cases, direct materials will have workings. So just check if we have workings, so that we can start from somewhere. So direct materials, we already have, for direct materials, just like any other material, we start with the check if we have opening stock, and I can see we have opening stock in the question, 1st October 2020. Opening stock, remember this is manufacturing account, so we're only dealing with we are interested in the raw materials. That's what happens, conversion of raw materials to finished goods in the factory. So Opening stock here will talk of raw materials, and that is 4,200. So opening stock, the total, because we are looking for direct material will go to the outermost column. So it's good that we work with the inner column. So raw materials will have 4,200. We put here so that the total of direct material will go to the outermost column. So opening stock, then we add purchases, and the purchases we are talking about here are purchases of raw materials. Purchases of raw materials. So let's check raw materials. Purchases of raw materials. Do you have that in the question? Purchase of raw material, the second item. Yeah, we have purchase of raw materials. It is the second item. Purchase of raw materials, 28,000. So purchase of raw materials, 28,000. And if there are workings on these purchases, then we better do the workings on the innermost column. That's the reason we have the 3 columns. So purchase of raw materials. I saw there we had this one, carriage inward of raw material. You can see it here. Carried inward of raw materials. And of course, yeah, I think we'll have that. Purchase of raw materials plus carriage inwards of raw materials. Yeah. So carriage inwards is 600. Since we have 2 items, we will use the innermost column. This was 28,000. And then add carriage inwards. Carriage inwards are the costs associated with the transportation of goods into the premises. So it was 600. So this will give us a total of 28,600, like that. 28,600. That is the purchases part of it. And then, of course, we go to the closing inventory. So closing inventory. Closing inventory of raw materials. Closing inventory, check the additional information. Closing inventory normally it's not in the trial balance show. So check the additional information. That's where we are likely to get that information. So closing inventory of raw materials. Here we go. Inventory as a 30th. So it's closing inventory of raw materials, which is 5.2. And remember, we have chosen to restrict the zeros. So we less this. Then what are we going to get? What we get will be the value for direct materials. So it's 42 plus 28.6 minus 5.2. That gives us 27,600. So this is the value of direct materials. And then we move to direct labor if we have. So check in the question. That is how we get the prime cost. Direct material plus direct labor plus direct expenses. So just check if we have, and of course you can see it here already. Production wages. Production wages. These are direct labor. Production. The word production takes place at the factory. So we'll actually, based on this term here, production, to classify this as a direct labor charge. So production wages 8,000. We come here and say we add production wages. Production wages. How much? 8,000. Like that. Then we check if we have any other direct expense. Production supervisor salaries. These ones, supervisor salaries will come under the factory costs. Office, that one doesn't apply here in the factory. It applies outside the factory. It will feature in the financial statements. Distribution costs, same. Factory insurance under factory overheads. Provision for unrealized carriage inwards. We don't have any other thing. Manufacturing royalties paid. These ones look to me like a direct cost, specifically for the manufacturing entity. Manufacturing royalties paid. So this one will classify it as a direct expense, and you can see it's 800. So we'll have it there as a direct expense. Remember, prime cost is direct material plus direct labor plus direct expenses. So let's check if we have any other before we can take that. We don't have any other. The additional information, check just to make sure there is no any other. Fuel and electricity are to be apportioned at 80%. That is a factory overhead incurred for the general hall. So I think we are done. So So production wages 8,000. Then we'll say manufacturing royalties paid. Manufacturing royalties paid plus 800. So this will come in as a direct expense. So 27,600 plus 8,000 plus 800, that gives us 36,400. 36,400, and this is our prime cost. Prime cost, we said, is direct material. You can see direct material. This is the value, direct labor plus direct expenses. Then once we are done with the prime cost, we add all the other production costs. We add other production costs or overheads. Other production costs or overheads. Let's just call them production overheads. Let's add other production overheads. So what are these other production overheads? The other overheads are indirect costs incurred for the general whole. So we just look at any of these other costs that have been incurred in the factory. So already we have here production supervisor salaries at 240. So you simply come here and write it. Production supervisor salary at 240. Production supervisor salary at 240. So it's good we have them here. Then after that we'll have production supervisor salary, office salary. This one is not doesn't apply. Distribution doesn't apply. Factory insurance at 600. So that is the factory level. So we'll come here and say factory insurance. Factory insurance 600, like that. Then we come back, check if we have any other. Provision for dealers profit, not now. Carriaginos, we've already used. Cash at bank, all these are not applicable. Bad debts written off, office administration, fuel and electricity. There was something about fuel and electricity. Remember, we're only picking costs that are related to the factory. There are those that are related to the factory. There are those that are not related to the factory. They are incurred at the business level. We are producing our own stuff to sell. So this is the cost we are preparing manufacturing at the processing or production level. So under fuel and electricity, we've been told that note 5. And it's always very important that we remember everything that is in the additional information. Alternatively, you can start with the additional information as workings. So fuel and electricity are to be apportioned at 80% to the factory and 20% to the office. So our interest is on 80% to the factory. So 80% of fuel and electricity will go to the factory. So fuel and electricity, you can see the charges are 1, 2. So we'll talk of 80% fuel and electricity. So fuel and electricity, 80% of 1,200. This gives us 960. That is how we go about it. So then we continue. Is there any other thing? Fuel and electricity, inventory, capital. These ones don't apply here. Factory building at cost. This is factory building at cost. You can see 16. Plant and machinery at cost 4.5. Motor vehicle at cost 2.4. So allowance for depreciation, we have them here. This is what has accumulated over time. Look at the date. This is 1st October 2020, and we are talking about 30th September 2021. So what has accumulated over time is this. Our interest is on the depreciation for this year, and specifically, look at how this has been framed. This is factory building. Factory building, so it means it's a factory cost. Plant and machinery. Plant and machinery, heavy machineries that are used in, possibly from this question, we'll assume in the production process. So most likely these two are going to be factory overheads or production overheads. But let's see if they have told us anything in the additional information. Depreciation, item number 2, depreciation is provided on cost as follows. So building 2.5, plant and machinery 10, motor vehicle 20%. They have not indicated which one applies to the factory, which one applies to the normal, the normal business. But since this one is very clear, it's factory over factory building, we will apply 2.5 and charge it to the manufacturing account. So we'll come here and say this is 2.5 of, remember again, it is depreciation on cost, not on the written down value. If it was on the written down value, we'll have taken factory building at cost minus the accumulated depreciation and then take 2.5% of that. But because it's on cost, we simply take the percentage of the price, the cost that the item basically was valued at the very beginning. So in this case, we'll come here and say depreciation. So we'll charge depreciation, and for depreciation we have the factory building, which is depreciating at the rate of 2.5%, so 2.5% of 16,000, like that. So what is that? 2.5, that is 0.025 times 16,000. That gives us 400. So 400. And then we come to the depreciation of plant and machinery, which was at the rate of 10% of, let's get the figure. Plant and machinery, you can see it's 10%. What is the value of plant and machinery? 4,500. So 4,500, like that, 4,500. So this gives us 450. For motor vehicle, we are going to assume that this one is used for selling and distribution. So we may not charge it here in the manufacturing accounts. So we're not going to charge it in the manufacturing account. Sorry for that. So with that, I think we should be done. Is there anything that we've not captured? Fuel and electricity, factory, allowance for depreciation, finished goods, manufactured goods. I think we have captured everything. So if we have captured everything, what is remaining is for us just to get the total. And the total is 240 plus 600 plus 960 plus 850. This gives us 2650. So bring the total here, 2650, add to that 6,400, and we'll get the answer. This is 39,050. 39,050. The 39,050 is the cost of goods available for sale. Cost of goods available for sale. COGAS. Cost of goods available for sale. And then, of course, this is just as the title says, cost of goods available for sale. And then remember, since we are almost getting out of the factory, we have to consider the work that is in progress. Work in progress. And for work in progress, we have opening stock and closing stock. We simply add the opening stock and we less the closing stock. So opening stock for work in progress is 2,400. So we have 2,400. Just go back to the question and get the 2,400. It's there. Opening stock. Yeah, opening stock, work in progress. This is what you're talking about, 2,400. And then closing stock, work in progress. This one is what you're talking about, 2,000. 2,000 because of the restricted zeros. So 2,000. 2,000, like that. So we less the closing stock from opening stock, just like we did. Remember, even here we have opening stock, less closing stock. The same reasoning. So 4,000. This will give us, is it 4,000? Sorry, it's 400, not 4,000. So this is 400. So this will give us 39,450. 39,450. So then there's somewhere here on how this should be, how we should proceed from here, because this is already what we call the total cost of production. This is the total cost of production. Total cost of production. And so maybe what we are missing here is the profit margin, and then we get the transfer price. Profit possibly that is expected here, and then you get the transfer price. Our interest is on the transfer price. And the question has been clear on the how we go about this. I think there's a place where they talked about that. Number 3, manufactured goods are transferred to the warehouse at factory cost, and we have already gotten our factory cost plus profit at 20% of the factory cost. So profit is 20% of the factory cost, and these are factory cost, total cost of production. So profit is 20% of 39,450, like that. So we take 0.2 times 39,450 to get 78.90. So this will be our profit, and when we add that, we get 39,450. We get the transfer price, which is 47,340. So that marks the end of our manufacturing account, just like that. That's just like that. This will give you around 6 marks, hopefully. Should give you around 6 marks. So then we come to the second part, because the question is asking manufacturing and statement of profit and loss for the year ended that. So we'll repeat this Timothy and Lisa partnership. This is the second part of this question. Timothy and Lisa partnership. Then you say financial statement. For the income statement for the year ended. For the year ended 30th September 2021. You underline that like that. Then you can also have the columns clearly indicated like that. So then we start. Of course, now this one here we start with the sales. This is an income statement. So sales. Just go back to the question, get the sales figure. Our sales figure was right at the beginning, which is 59,220. So you simply come here and say sales 59,220. Unless if we have workings, I've not seen any working. If we had workings, we'll have pushed it in the inner column. But since we don't have any workings, we go straight there. And then we go to less cost of sales. Cost of sales. And under cost of sales, we'll have the opening stock. Opening stock. This time round is opening stock of finished goods. So we go get opening stock of finished goods. Opening stock finished goods. Where is it? Opening stock finished goods. That is 1,800. 1,800. So opening stock of finished goods 1,800. Put that in the inner column. And then we'll get the value of the goods, and this time now we are not purchasing from outside, we are only getting these goods from our factory. So we'll simply stock of the transfer price. So we add the transfer price, which is right here for 7,340, and then we less the closing stock, unless if we have any other adjustment, which I doubt if we have. So go to closing stock. We have closing stock is finished goods. You can see inventories. This is 3,600. 3,600. So we'll have it there like that. 3,600. So we add. This is 1,800 plus 1,800 minus 3,600. Gives us 45,540. 5,540 like that minus 59,220. This gives us 13,680. 13,680. That becomes our gross profit. So far so good. We are done with the trading account. Now we are going to the profit and loss account, where we're supposed to add any income and gain. So let's check if we have any income and gain. Do you have any income and gain? Sales, check if there's any income, commission received, discount received, rent received, such like stuff. Decrease in provision for bad and doubtful debts. We don't have bad and doubtful debts. So I suppose we don't have anything. So we move on to expenses and losses. Less expenses. Expenses, less expenses and losses. Oh, there's something we're almost forgetting. There's something we're almost forgetting. There is an income, which is very important. This one. Where is it? This one. This must be factored here, because now we are working on profit and loss. So this must be captured here. So we'll say we add manufacturing profit, so that it is counted. Manufacturing profit, normally we add it as part of the income for the business. Income and gains, any other income, the rent receivable, commission receivable. Now this time there is a profit that was actually charged, so which must be included here. So manufacturing profit, just go back, it's here, 7890. So add it here, 7890. Please don't forget that. So minus 7890, that gives us 21,570, 21,570, like that. So that is the gross income. And then we now start lessing what? The expenses and losses. We'll simply go back to the question and pick all these expenses and losses. Normally we have the administrative, selling and distribution, expenses and the staff. So sales, purchase of raw material, production, office staff salaries, we are already there. So we start from there. Office staff salaries, 3,600. You always need to check if there are any additional information. Office staff salaries, 3,600. If there is any additional information, you need to factor that, but we don't have any additional information touching on office staff salaries. Then you have distribution cost, 2340. So we have distribution cost, 2340. We capture that. So distribution costs, 2340, like that. Then you go pick another one. If we have factory insurance, we've already factored that one. Provision for unrealized profit, we'll come back to this one. Actually, this is where it's supposed to be. So we'll come back to, let's just do it. Provision for unrealized profit. Now, what happens under provision for unrealized profit, PUP? Provision for unrealized profit. If there is an increase, we are supposed to debit the P&L. Provision for unrealized profit. So what happens is there is this closing inventory in our financial statement. You see, we have closing inventory of 3.6 million. The assumption here is that we might not have sold everything that was transferred to us from the manufacturing entity, because we still have closing stock, and you can see closing stock of 3.6 million. But then we charged a profit of 20% of all the items that were transferred to the trading account. We had charged a profit, and you can see even the profit is here, is reflected here. But some of these goods might not have been sold. We charged the profit, but some of the goods might not have been sold. So that is what we want to factor in when we talk about provision for unrealized profit. Some of this profit, yes, it will be profit because it was charged in the manufacturing account, but it has not yet been realized because we still have some goods with us worth 3,600. That is the closing stock as at the end of the year. So what we do is we will basically in this question, we want to remove the profit that we had charged. And you remember we charged the profit at the rate of 20% of cost. It is here. manufactured goods are transferred to the warehouse at factory cost plus profit at 20% of the factory cost. So that is what we are interested in. So we'll get 20% of what we had transferred times the closing inventory, this one. We are interested in the profit that is still in these inventories that are still with us as at the end of the year. So 20% of 3,600, that will give us 20%, 20 divided by 120 times 3,600. That gives us 600. So 600 minus what we had already provided as provision. I think it was, forgetting that figure. What we had provided as provision is, provision for unrealized profit 360. So minus 360 minus 360. This gives us 240. So that's how we go about it. That gives us 240. So it's an increase in stock of 240. That's how we go about it. Then continue. Carriage inward, we're done with that. Cash at bank, 12% bank loan. 12% bank loan means that the bank loan at max interest at the rate of 12%. So 12% of 600 is, 12% of, you can get this right. It's 12% of 6,000, that is 720. So simply come here and say bank interest. Bank interest 720, like that. Then we say the next thing is bank loan interest. 12% bank loan, yeah. So 720 bank loan interest. What you paid is 600, though the interest is 720. We are interested in the interest that was actually incurred, or no, for that year, not what was paid. So what this means is that you paid 600 instead of 720. So 120 is still outstanding, and that will feature in the balance sheet as an accrual. So these are accounts receivable, accounts payable, manufacturing royalties paid, bad debts written off 40. So we have bad debts written off at 40 shillings. Bad debts written off. Bad debts written off. How much? 40. Then the next thing is let me see. Bad debts written off 40. Office administration expenses 880. So office administration expenses 880. Office administration expenses. This is 880 shillings. Then next, office administration expenses, fuel and electricity. Remember this one, now we're interested only in 20%. We had already captured 80%. So 20% of 1,200 is 240. So fuel and electricity, it's here. Fuel and electricity, 20% to the office. So 20% of 1,200 is 240. So fuel and electricity, this is 240 shillings. And what we are talking about is 20% of 1,200, like that. So 240. Then the next thing is inventories. So this one doesn't apply. Capital drawings. Motor vehicle. Remember we had not worked on motor vehicle. So motor vehicle, the depreciation is 20%. So 20% is also on cost. It will just be 20% of 2,400, which is 480. So depreciation on motor vehicle. Depreciation on motor vehicle. Depreciation on motor vehicle. Motor vehicle. This is 20% of 2,400. 20% of 2,400. This gives us 480. like that. Good. Then next thing is we're done with that. We're interested in the depreciation for that year, so the accumulated depreciation has nothing to do with us, especially since the question has been so clear that the depreciation is on cost. Most of this will find their place in the appropriation account. So I think we are good to go. So let's add this. Let's add that. So this will be 3600 plus 2340 plus 240 plus 720 plus 880 plus 40 plus 240 plus 480. The best way to go through this is you need also to be having a calculator with you, so that accounting is practical. So if you work alongside me, you are likely to get better results as opposed to if you just say that you want to follow me on what I'm doing. So this will be 21,570 minus 8540. That gives us, I've added 21,570 minus 8540. This gives us 13,030. 13,030. You're supposed to subtract this because these are expenses. So 13,030. This is our net profit. Good. So if that is our net profit, the next thing is how are we utilizing this net profit? So we got the appropriation account. In the appropriation account, we first of all get monies that will come in, of course, from the partners, and then how they will spend that money. And the first thing is money that will come in is on interest on drawings, because they took the money that belongs to the business, so they are supposed to pay interest to the business. So it's the business that is basically receiving this money. So interest on drawings is to be charged at 15% per annum. So 15% per annum, we go to the drawings, and you can see the drawings. Timothy 800, the other guy is Lisa 400. So we simply come here and say interest on drawings, interest on drawings, and we say for Timothy and Lisa, Timothy is 15% of 800, Lisa is 15% of 400. I think that's how it goes. So 15% of 800, this will give you 15 times 8, it gives you 120. So 120, and then this one will give us, of course, half of this, which will be 60. So since these are, we might want to work this in the innermost column. I think for better results, let's work this, let's do this in the inner. Yeah, we can also retain, let's just retain them here. So 120 plus 60, this gives us 180, like that. Then, is there any other income for the appropriation account, money that comes in the business? Interest on capital, it's the business that pays, because it's the partners who have invested capital in the business. Commission is the partners who receive. Salary, it's the partners who receive. So I think let's move to the next thing. The next thing we move into should be the partnership agreement. Each partner is entitled to a salary of 100,000 per month. So per year is 100,000 times 12 months in a year. So 100,000 times 12. So we'll come here and say partnership salary. Partnership salary. Timothy and Lisa, and this is 1.2. Remember, we are restricting the zeros, so this is 2, 4. But this one now, we are paying them. It's the business that pays them. So this, they were interest on drawings, the business that it is earning, so we add to the net profit. But here, these are money going out. It's the business that is paying the partners. So we have to show it as a deduction. Then you come to the commissions. Commission, again, it's the business that pays the partners. let's just identify how much the business paid them, each of the partners. So commission is based, Timothy is entitled to 10% commission based on factory profit, while Lisa is entitled to a 10% commission based on net profit. So what is the factory profit and what is the net profit? All of them is 10%. So 10% of factory profit, this is the profit, factory profit. So Timothy 789, and then Timothy, let's just finish up with that. Timothy 789, this is 10% of factory profit, which was 7890. And then Lisa is 10% of the net profit. Lisa 10% of the net profit. Now we have our net profit here. This is our net profit. Net profit 13030. So Lisa will get 10% of 13030, which means she will get 1303. And when you add the two, 789 plus 1303, we get 2092. So 2092, it is the business that is paying them, so we deduct. Then there's something else remaining, interest on capital. Interest on capital is to be charged at 10% per annum. What are their capital figures? Capital 10,000 and 8,000. 10,000 and 8,000. Good. So 10,000 and 8,000, and interest is on capital is at 10%. So 10,000 and 8,000. So we come here and say interest on capital. Interest on capital. Timothy, Lisa is 10% of 10,000. This gives us 1,000. 1,000, sorry. And then for Lisa is 10% of 8,000, which gives us 800. So total is 1,800. Who is paying? The business is paying them. So this is money that goes out. So let's get the total. If there is nothing else, I doubt if there is anything else, because we captured drawings, capital, commission, we captured salaries, we captured. If we go back to the question, current accounts, will prepare the current accounts for it. There's nothing more. So other than profit, now we are looking at sharing the profits between the two partners. So Timothy and Lisa are in partnership, sharing profits and losses equally. So they are sharing profit and losses equally. So you see, we come back here. So it will be 13,030 plus 180 minus 24 minus 2092 minus 1800. That gives us 6918. So we have 6918 here, 6,918, an amount which the two are supposed to share equally. 6918 is the amount which the two are supposed to share equally. And we'll come here and say profit share Timothy and Lisa. So equally, this means Timothy will get 6918 divided by 2. That will be 3459. 3459, and Lisa 3459, which will give us 6918. Then with less, we get 0. So that is the appropriation account, basically showing how the net profit will be utilized from the net profit up to the very end. And you can see that's how the two will share. So this 3459, that will be the profit for each of them, which will be now subjected to tax at their own individual levels. So we are done with that part. The next part is a financial statement. This should give you like 6 marks. So again, we start Timothy and Lisa. It's quite a lengthy question. Timothy and Lisa partnership. Timothy and Lisa partnership. Then we say statement of financial position. Statement of financial position. Financial position. And since it's a balance sheet, say as at 30th September 2021, like that. And then as usual, we have shillings, and we have shillings, and we restrict the zeros. So restrict the zeros like that. Restrict the zeros like that. So for balance sheet, we start with what we normally do, we take the non-current assets. We'll start with the non-current assets and then add current assets, let current liabilities, and then we compare with the finance by section. So we had factory buildings, remember? Then we had plant and machinery, then we had motor vehicle. So let's get the figures from the question. Plant and machinery building. So this is they're here, 16,045 and 24. 16,045 and 24. So 16,000, these are their book values. So 16,045 and 24. Then we are supposed to get the accumulated depreciation so far. We less the accumulated depreciation from this, and we'll get the net book value. So this column is accumulated depreciation, and then here we get the net book value. So how do we get the accumulated depreciation? We take what has accumulated up to 1st October 2020 plus the depreciation for this year. For buildings, we'll have 1,200, which you can see, plus the depreciation for this year under buildings. The depreciation for buildings was 400. So 1,200 plus 400, that is 1,600. So you simply come here and have 1,600. Then 16,000 minus 16, the answer is 14,400. So that's what we have here. We repeat the same exercise for plant and machinery. The accumulated depreciation was 900. So 900 plus the depreciation for this year. 900 plus depreciation for this year. Depreciation for this year is 450. So that is 1350. So 1350. So this will give you 3150. Basically 45 minus 1350. And then for motor vehicle, the accumulated depreciation was motor vehicle 720. 720 plus accumulated motor vehicle. Let's go to the P&L. So motor vehicle is 480. So 720 plus 480, that gives you 1200. 720 plus 480, that gives you 1200. So our depreciation will be 1200, and this basically gives us a figure of 1200. I don't think if we have any other asset, so it will be 14,400 plus 3150 plus 1200 plus 3150 plus 14,400. Like that. That gives us 18,750. 18,750. Then we add the current assets. And for current assets, we have the inventories. We can right away start with the inventory for raw materials, for WIP, and for finished goods. These are things that are just obvious. So go straight to, you can see the inventories, 522 and 36. 522 and 36. So just pick them the way they are. 522 and 36, like that. Then we go to the next current asset. The next current assets, prepayments or whatever. These are depreciation, no, that one, no. So there's nothing there. Let's go back to the question, sales, purchase, anything. Cash at bank, of course, this is an asset. Cash at bank is 7,200. So cash at bank, 7,200. Accounts receivable, 1,400. Accounts receivable, 1,400. And we don't have any other. So cash at bank, 7,200. And then accounts receivable, 1,400. Cash at bank, 7,200. And then accounts receivable was 1.4. Like that. So let's get the totals. This is 5.2 plus 2,000 plus 3.6 plus 7.2 plus 1,400. That gives us 19,400. So 19,400. Then we go to current liabilities. I saw accounts payable. I have accounts payable alongside accounts receivable. So accounts payable, how much was it? Let's just pick everything. I'm starting from right at the top. %, bank loan. There was an accrued bank loan of 120. So accrued bank loan of 120. Accounts receivable 600. You remember it was 120 because the bank loan was 6,000. 12% is 720, but we only paid 600. So accrued is 120. What we had not paid outstanding is 120. 720, which is the 12% of 6 million. And then what we paid is 600. So 720 minus 600, 120. So accounts outstanding interest is 120. And then accounts payable, can see accounts payable 600. So accounts payable 600. Accounts payable, let's come down here. Accounts payable 600. Then outstanding, accounts payable, then outstanding or accrued interest is 120. 120. Outstanding or accrued interest is 120. Then what else do we have? Check if we have anything, fuel. Depreciations, we've already factored that. So I doubt if there's anything. So with this gives us how much? 720. So we'll less 720. Yeah. So let's get the total. This is net capital employed. Net capital employed. So 18,750 plus 19,400 minus 720. This gives us that's 7,430. That's 7,430. This is our net capital employed. So the other side we have to say finance by. And then of course we'll start with the capital accounts. Timothy and Lisa. And if I'm not wrong, the capital accounts was 10,000 and 8,000. This gives us 18,000. Then we go to current accounts. Timothy and Lisa. Now for current accounts we've not worked out. At capital accounts, 10,000 and 8,000. Let's just confirm. 10,000 and 8,000. They are here. These ones will not change. So 10,000 and 8,000. They are here. 10 and 8. But for current accounts, definitely we have to prepare another book to explain, because there's quite a lot. They have received commission, they have received salaries and the group. So we have to prepare another book just to show how. So let's prepare this. Okay, so we'll have to prepare a book to show. If I get the lines right, and to show the current accounts. That's how we prepare the books, to show the current accounts of partners. So we'll call them current accounts. This is Timothy, Lisa. Of course, this is the debit side, that is the credit side, and we'll start with the balance brought down for both Timothy and Lisa. It's a credit account because this is a, so sorry for that. I think I'm carrying my table along with me. So let me just return this table where it's supposed to be. This is where the table is supposed to be. So yeah, I've finally succeeded in leaving it there. So where are we? We want current accounts, so it's 400 and 600, and then we'll now factor in all these other things that have just taken place. So 400 for Timothy, 600 for, it's 400 for Timothy and 600 for Lisa, like that. Okay, so we factor in, we have what? Basically, let's just go to the appropriation account. That's where we get a lot of these things. So we have interest on drawings. Interest on drawings, it means it's partners who are gaining. Partners are gaining. So anytime, interest on drawings, partners are losing. They are paying to the business because of the drawings. Drawings reduces their investments in the business. So actually, we should start with the drawings. And drawings you can get from here. So drawings were 800 and 400 respectively. You can see drawings 800 and 400. So drawings, this one reduces their net worth in the business. So we'll have drawings on the debit side. Anything that reduces their wealth, so it's 800 and 400. And then interest on drawings, it means they're the ones who are paying the business. Interest on drawings, again, we can get this figure right from here. Don't need to go up there. Interest on drawings, I think the figure was somewhere here. Interest on drawings, 120 and 60. 120 and 60. So 120, 60, like that. Then you go back again. All these are things that affect the current accounts. So partnership salary. Salary, this one increases on their the money, their wealth. So partnership salary 1212. So it's on credit salaries. They all got 1212. Then look, the next one is partnership salary. Commissions they received. So that one increases their wealth. 789 and 1303. 789 and 1303. So 789 and 1303. This is commission received. 789 and 1303. Then next we have gone far. I was supposed to stop here. Interest on capital 1,800. Interest on capital 1,800, and then profit share. So interest on capital, remember they're the ones who are getting this money. Interest on capital 1,800, and then profit share, I think it was 34.59 for both of them. 34.59 for both of them. Let's just compare. Let's just confirm, sorry. 34.59, there we go. So then, if we have captured all this, the next thing is to close the books. So we close the books, and we close the books. So what is, how do we close? We add both sides, 600. So 600 plus 1200 plus 1303 plus 800 plus 34.59. That gives you 73.62. 73.62. So it means this side also will have 73.62. And then 400 plus 1200 plus 789 plus 1000 plus 34.59. That gives us 6848. 6848. 6848. I'm doubting this calculation of mine for Lisa. Let me just repeat. 600 plus 1200, that is 1800 plus 1303 plus 800 plus 3459. 7362. It's okay. So 7362. So if it is 7362, what do? We subtract the other side. So 7362 minus 460. This gives us 6902. 6902. And then the other side 6848 minus 920. That gives us 5928. 5928 like that. 5928 like that. So these are the figures that we are interested in. So we'll say balance carried down at 5928 and 6902. So for Timothy 5928, so simply come here and say 5928, and then for Lisa, get this total 6902, bring here 6902, and then we add the two, 5928 plus 6902. This gives us 12830. 12830, like that. Hope. Anything else remaining? 12830. Do you have anything else remaining? Let me see if we have anything else remaining. I think this will be the finance by part. Then I think the only thing that we have not included now is the long-term loan, which was here. We factored everything except the long-term loan, which was 12% bank loan, 6,000. So this one will come and say long-term liability, bank loan. Long-term liability, and we have a bank loan of 6,000. So that should be able to give us the net capital employed. I hope it balances net capital employed. I hope it balances net capital employed. So from the look of things, it's not going to balance, but let's see where we might have gone wrong. So this is 18,000 plus 12,830 plus 6,000. That gives us 36,830. 36,830. So the difference, 36,830. 36,830 minus 37,430. This gives us 600. So there's a difference of 600. Let's find out the 600. Let's find out the 600. So let's find out the 600. That's our difference. So it means we must have just done some mistake somewhere. We can just redo the computations. This is 17, 18, 750. That's okay. Raw materials 52236. You add this 72, 10, 8, 10, 8 plus 8, 6. Yeah, that's okay. This is 19,400. Just recheck on your computation. This is 720. That's 7,430. This is okay. 18,000. This is 12,830 is okay. Okay. So where could you have gone wrong? Raw materials, there must be something that we left out. Let's check out what we could have left out. That is normal in accounts, but you need to be very keen. Sales, purchase, Provision for unrealized profit. Did we factor this? Provision for unrealized profit. This is how much provision for unrealized profit? Let's just check this. This was 360. 360. Provision for unrealized profit is 360. So this is where I think this is where we got it wrong. We were supposed to factor in this provision. Remember, our provision increased from 360 to 600, and it's actually captured in one of the workings here. So it's actually 600. So provision for unrealized profit, we have two options. We can either have it under the current liability section, or just deduct it from the finished goods. So let's just deduct it from the finished goods. So we'll have 36 minus 600, which is so that here we have 3000 as opposed to we need to factor that provision for unrealized gains. You can either deduct it directly, or you can put it under current liability. So we've chosen to do it directly. So here we'll have 3000. And that means that we'll reduce our figure here by, so this will be 18.8, sorry for that, 18,800. And then when we add now, this will be 18,750 plus 18,800 minus 720. That gives you that 6,830. 36,830, and this 36,830, and you can now see the figures are agreeing. 36,830, 36,830. So this is net capital employed, and this will give you all the 8 marks that have been set aside for that particular question. 36,830, 36,830, it has agreed. So thank you. This is how it's supposed to be done. It's a lengthy question, but it should take you less than 30 minutes. So just work with 30 minutes. You need to do a lot of practice to perfect on your speed and accuracy. 30 minutes, good enough for this question. If you can extend just by a few minutes, well and good, but work with 30 minutes. So with that, thank you. It has been a tiresome question, but thank God we've done it well and it has agreed. Subscribe, share. Thank you.